Today's tutorial we will answer the question, what is Forex and where it came from. Forex stands for foreign exchange. It is also sometimes abbreviated as simply FX. Investopedia defines foreign exchange as the exchange of one currency for another, or the conversion of one currency into another currency. So simply put, foreign exchange is the exchange of currencies. So let's have a look at an example. Say for instance you're going on a holiday to Europe. In that case, you will take your American dollars and go to the exchange shop and convert them into euros. By doing this, you've conducted a currency exchange and therefore you have become a participant of the Forex market. So here's the Forex market, and who are the major players here? Well, first of all, of course, it's governments. Governments use the Forex market to meet certain economic goals, whether it's to have a lower exchange rate compared to a certain currency or a higher exchange rate. It all depends on whether the country is importing or exporting goods, and many various other factors. Also the central bank. In most cases, the central bank is the financial arm of the government, but sometimes the central bank is more independent for some countries, and the central bank also uses the Forex market to move around its reserve of currency and monitor the situation and things like inflation, interest rates, and so on. Next, we've got normal banks. Normal banks trade on the Forex market to define which exchange rates should govern the exchange of currencies. Also, other financial institutions participate in the Forex market, and an example of that would be the pension funds in the US. They are massive companies who have lots and lots of money, and sometimes they need to make transactions on the Forex market as well. Other players on the Forex market include normal companies such as BMW, Coca-Cola, General Motors, and any other multinational company that you can think of. And that's because these companies have operations across the globe, and therefore they are forced to convert currencies all the time in order to pay suppliers, pay employees, and so on. Another type of major players on the Forex market is hedge funds. Hedge funds are actually funds that are, or organizations that are designed to speculate on the Forex market and bring profits to their investors. So even though they're called hedge funds, they're mostly now they've kind of developed to become very aggressive and profit seeking. So they take on large funds from investors, and then they try to trade this money on the Forex market to make profits, and they earn fees, and plus they earn commissions if they do create profits. And finally, the normal traders such as you and I and George Soros, just people who speculate on the Forex market to make a profit. So they're also participants of the Forex market, and for example, George Soros was able to make over $1 billion of profit in 1 month. That's one of the reasons why what he's famous for. So all those participants together, as you can imagine, create massive volumes of money. And to be more precise, the volume of the Forex market is $5 trillion. That is 5 and all those zeros behind it, and that is per day. $5 trillion goes through the Forex market. That's an unbelievable amount of money. And just to put that into comparison, the largest stock exchange in the world is the New York Stock Exchange, and the total market capitalization of the New York Stock Exchange, that means if you take all the companies that are listed on the New York Stock Exchange and you put all of their values together, then you will get only $18.7 trillion. And that's the total capitalization of that exchange. Whereas on the Forex market, you have $5 trillion going through the market per day. And that just shows that the Forex market is by far the biggest financial market in the world. So this is the euro-dollar daily chart. And you can see that the current price for the euro-dollar is 1 1.2524. So what does that mean, and how do we understand that? Well, let's look at the currency pair at the bottom. The currency on the left of the pair is called the base currency. In this case, it's the euro. And the currency on the right is called the quoted currency. In this case, it's the US dollar. You may see this price of 1.2524 for the US dollar currency pair written the following way. This is equivalent to writing it out as euro/US dollar equals 1.2524. Now let's quickly simplify this example to understand it a bit better. Let's replace the euro currency with apples. And let's say that we're quoting the price of apples in US dollars. Personally, I really like this approach because it takes one of the unknowns out of the equation. If you think about it, euros, like any other money, is a tangible object. You can hold it in your hands, you can measure it, you can weigh it up, you can count it. It's something that actually physically exists. So that means we can easily replace it with something else that also physically exists, but is better known to us, like apples, for example. You can count apples, you can weigh them up, and you can hold them in your hands just like euros. So there's no harm in replacing euros with apples just for the sake of this example. So here you can see that a price of a single apple in American dollars is 1.2524, and that's exactly what this equation means. And now if we go back to the euro, we can quickly understand that the chart in fact represents the price of one single euro in terms of US dollars. So this means that at the point in time when the snapshot was taken, for 1 euro you would get 1.2524 US dollars, and conversely, to buy 1 euro you would need 1.2524 US dollars. And this principle applies to any currency pair. There are over 180 currencies in the world, and you can combine any two of them to give you a currency pair. Most traders identify two main groups of currency pairs, and these are the majors: the euro US dollar, the dollar yen, the British pound dollar, the Australian dollar American dollar, the dollar Swiss franc, and the dollar Canadian dollar. And also the second group is the crosses. Crosses are, simply put, all currency pairs that do not include the American dollar, such as the euro British pound yen, Australian dollar Canadian dollar, and so on. And of course there are also all other currency pairs. So if we imagine the Forex market, then it's got lots of different participants, such as major banks, central banks of governments, investment banks and investment companies, other normal companies that need to conduct foreign exchange transactions. And these are all the major players of the foreign exchange market, and they constantly transact with each other, and they always transact in very, very large amounts of money. We're talking billions of dollars here, and so together they comprise the Forex market. So how does a person such as you and me get into this Forex market? Even if we have a deposit on our account of $50,000, and more likely than not it's often less than that, even with such a large deposit, it's hard to get into a market where an average transaction is several billion dollars, and the daily volume is measured in trillions of dollars. So how can we get it there? And that's where the broker comes into play. A person such as you and me will go to a broker, and the broker will also work with a lot of other people, individual traders who will also go to this broker. And the broker will then aggregate all these transactions and send them to a bank. So a broker has an established relationship with a bank, and because it can scale up all of these little transactions that all the clients of the broker conduct, then the bank is more willing now to work with the broker. There are many different types of brokers and different types of relationships between the broker and the bank, and they include market maker brokers, STP brokers, ECN brokers, and so on. However, at the end of the day, the concept remains the same. A single individual person cannot gain access to the Forex market and has nobody to transact with. But a broker can facilitate access to the foreign exchange market to each one of us by scaling up our transactions. Alright, so ask and bid prices. When you go on a holiday overseas, you usually want to exchange your home currency for the domestic currency of the country you're traveling to. And in order to do that, you would go to a Forex exchange booth. And these booths will always have two different prices, a we sell price and a we buy price. And depending on the transaction you're trying to make, you will be quoted at one of the two prices. So if you're exchanging your home currency for the domestic currency of the country you're traveling to, you'll be quoted at one of these two prices. And when you come back and you have all this excess currency of that other country and you want to exchange it back into your home currency, you will be quoted at the other price. Same principle applies on the Forex market. Any Forex currency pair actually has two prices, the ask price and the bid price. The ask price will always be above the bid price, and the ask price is the price that you would be quoted at if you want to buy the base currency. If you want to sell the base currency, you will be using the bid price. So here we're using the British pound Australian dollar as an example, and in that currency pair, the British pound is the base currency, the Australian dollar is the quoted currency. So if you want to buy British pounds, then you will be using the ask price. And this means that for every 1 British pound, you would have to pay 1.8873 Australian dollars. Now, if you want to sell British pounds, then you would be using the bid price. And for every 1 British pound, you would get 1.8866 Australian dollars. So as you can see, you're always paying more to buy than you're getting when you're selling. And that's the principle of the Forex market. Spread. So as we discussed, the ask price is always above the bid price, and you will always pay more to buy 1 unit of base currency than you will get when you sell 1 unit of base currency. And that difference between the ask and the bid price is called the spread. So let's calculate the spread for this particular example for the British pound Australian dollar currency pair when the prices were as they're illustrated on this chart. So the spread is the ask minus the bid. That means 1.8873 minus 1.8866, and that means 0.0007. So that means less than 1 Australian cent. That is 0.07 of an Australian cent. And this is in Australian dollars because the currency pair is British pound Australian dollars. So Australian dollar is the quoted currency. Remember our examples with apples. So British pound here is like the apple, and Australian dollar is the currency that it's been valued in. So in this instance, the spread is 0.07 of an Australian cent, which is very low in our kind of understanding of the world, that when we go to an exchange booth, the spread is usually at least a couple of cents, maybe $1 or so on certain currency pairs. But on the Forex market, the spreads are very low, and this is called very tight spreads. Simply put, the brokers actually earn this money, or the banks and the brokers, they kind of share this spread, and this is your cost of conducting a transaction on the Forex market. Pips and points. So this is going to be quite an important tutorial because a lot of people get these things confused, and I'd really like to help you get started in the Forex market, knowing these things right away. So once again, let's calculate the spread. So the difference of the ask and bid price in this case is 0.00065 units of the quoted currency, which is Australian dollar, and that equals to 65 points. So let's remember that even in the 5-digit quotation system, a point is the minimum change that the currency pair can experience. In this case, the minimum change is 0.00001, and if you multiply that by 65, then you will get your spread. So the spread is 65 points. On the other hand, the spread is approximately 7 pips. You can say 6.5 pips, you can say 7 pips, doesn't really matter. Just to sum up, we've got the 4-digit system and the 5-digit system. An example is the British pound Australian dollar quotation that we looked at, 1.8866 in the 4 digits, 1.88663 in the 5 digits. 1 point in the 4-digit, 1 point is always the minimum change. In the 4 digits system, it's 0.0001. In the 5-digit system, it's 0.00001. A pip never changes. A pip is always fixed regardless of the quotation system, and it equals to 0.0001. And a pipette, there's no such a thing in the 4-digit system. In the 5-digit system, because there's enough precision, you can talk about pipettes, and it's 0.00001. However, I do advise not to use this term because it's not frequently used. So you will notice that some traders out there get this mixed up, and actually some respectable traders can get this mixed up because this is terminology. And before we finish up, a quick note on Japanese currency pairs as promised. So if a currency pair is quoted in Japanese yen, meaning that the Japanese yen is on the right, you will see that everything is shifted by approximately or exactly 100. So there's not, in the 4-digit system, there's not 4 digits but 2 digits after the decimal point. In the 5 digits, there's only 3 digits. So everything else stays exactly the same, just multiply everything by 100. And that's just been associated with the way the Japanese yen has historically been priced. For instance, right now, $1 American can buy you 118 Japanese yen. Alright, so lots. A lot is a measure of volume of a transaction on the Forex market. One lot equals to 100,000 units of base currency. 0.1 lot equals to 10,000 units of base currency. 0.01 lot equals to 1,000 units of base currency. Also, 0.1 lot is called the mini lot, and 0.01 lot is called the micro lot. So let's have a look at an example. For instance, you want to trade the euros dollar, and you want to conduct a buy transaction with the volume of 1 lot. That means that you will be buying 100,000 euros in that one transaction. The ask price with your broker is currently 1.23228, and that means that in order to buy 1 lot of euro US dollar, you need 123,228 American dollars on your account. So obviously this number is astronomical, and when we come to trade the Forex market, we don't have such money. How can we still trade the Forex market? Well, we'll find out about that when we talk about leverage. So, leverage. As we discussed, in order to buy or sell 1 lot of euro dollar, you need 123,228 American dollars on your account, which is a lot of money. But even in order to trade with 0.1 lots, you need 12,000 American dollars. And in order to conduct the smallest transaction possible, a micro lot, 0.01 lots, you still need $1,200 on your account, which is a lot of money. And what happens if we can't afford to have an account of that size, or we're just not ready yet? We're practicing and we don't want to invest that much money into the Forex market. How do we trade then? Well, this is where leverage comes into play. The concept of leverage has a lot of negative sentiment around it, and people kind of think that it's bad for you or dangerous, which is completely not true. And in this and the next tutorial, we will disprove those fears. So what happens with leverage is your broker will actually lend you money in order to help you conduct transactions on the Forex market. So in this picture, your money is on the right and the money the broker lends you is on the left. So let's have a look at a particular example. For instance, your balance is $500. And you want to conduct a transaction with the volume of 0.1 lots on the euro-dollar currency pair. So you require 12,322 American dollars to conduct this transaction. Obviously, your balance is insufficient at this stage. But with leverage, if your leverage is 1 to 100, then your broker will actually only require you to have 1% of that money, and the broker will lend you 99% of the required amount. So in this case, your broker will lend you $12,199. So you're borrowing 99% of this required amount. All you have to invest is $123 of your own money. So that is 1% of the transaction, and that is much more affordable with your balance of $500. And in this case, you can now conduct this transaction and participate in the Forex market, either buying or selling the euro dollar. So that's how leverage works. Equity and margin. In the previous tutorial, we explored an example where we were opening a hypothetical order of 0.1 lots. Now, to create this transaction, we required $12,322. And because that was quite a substantial amount, we explored the concept of leverage. And in fact, we found that with a leverage of 1 to 100, we could borrow 99% of the required amount from the broker, and we would only be required to put in 1% or $123. Now that amount that we need to put in, the $123, is called the margin for this transaction. And today we're going to talk more about the margin and find out exactly why the broker is willing to lend us 99% and how leverage works in the background and how all of these concepts play out when you open an order and when the market goes against you and when the market goes in your favor. So let's jump straight into it. So here is our $500 balance, and now we want to open that transaction which we talked about. So the broker puts in $12,199, we put in $123, the $123 is our margin, and the remaining funds, so the 500 minus the 123, the $377, that is called the free margin. Now here we're going to introduce one more concept, and that is the concept of equity. Now normally equity is defined as the balance on your account plus or minus any unrealized profit or loss. So basically your balance is constant until you actually close your transaction, but your equity reflects whether the market is going in your favor or it's going against you. However, in this example, to start off with, we're going to kind of introduce equity backwards. We're going to introduce equity as the free margin on your account plus the margin. There's no big difference, and you'll see just in a few moments how that is exactly the same as what we discussed about balance and unrealized profit or loss. So there's our equity. We're going to outline it with a green bracket here on the right. And now let's see what happens as the market moves in either direction. So we'll start off with by looking at what happens when the market moves against us. So if the market moves against our position, then first of all, let's say it moved against us and the unrealized loss on our account is $100. So as you can see, the margin is intact, the broker funds are intact, but the free margin has reduced by $100. And therefore, our equity has also reduced by $100. At the same time, we should note that the balance hasn't changed. So that big box, the overall box is still $500, and still it looks like we have $500 on our account because that's our balance. But in reality, there is an unrealized loss, and it's called an unrealized loss because you haven't yet closed the transaction. So that loss might change into a profit with time, or it might increase as a loss. So if the market keeps going against us, now the free margin has reduced by $200 and the equity has reduced by $200. And at the same time, the borrowed funds and the margin, the frozen margin, are still intact. Now, what happens if the market keeps going against us? Well, what will happen is a stop out. So a stop out is when the broker sees that you have lost quite a lot of funds and you don't have any free margin left, and in that case the broker will automatically close your position, and this loss will become a realized loss, and that way they will be able to pull out of this position. Now the stop out can happen when all of your free margin is eaten up, so when you only have margin left, or maybe when you have half of your margin left. So the broker might, in its terms and conditions, specify that it will allow 50% of the margin to be used up before the stop out occurs, or it might allow 70% of the margin to be used up. So you have to refer to the terms and conditions of your broker to understand at which point a stop out will occur. And another thing you should be aware of is that sometimes there'll also be a margin call. So a margin call normally occurs before a stop out, and it's a warning from the broker telling you that you're getting very close to the stop out level and you should intervene and do something about it. Now let's see what happens if the position goes in your favor. Back to the start, here we've got our equity on the right, free margin and margin, and let's say you have set a take profit somewhere up at the top over there where the dashed or the dotted line is. Now, if the position moves in your favor, so here we can see that we've earned some money. As you can see, your position still isn't closed, so your balance is still $500, but your free margin has increased. So any unrealized profit or loss is being added to your free margin, and therefore, as you can see, your equity is increasing. And that's a good thing, because now you can use this free margin to open more transactions if you wish to do so. But we're not going to go into that. Let's continue with this example. So your free margin is increasing, your equity is increasing, and the market keeps moving in your favor, and it hits your take profit. Hooray! Your free margin has increased, your equity has increased. At the same time, you can see that the margin is still the same, still $123, and the amount of money that you borrowed from the broker hasn't changed. It's still $12,199. So what happens next is your position closes. The broker pulls back their amount, so they take back their $12,199, and your margin is released, and it is added to back to your account. So it was always on your account, but now it's released and it's no longer a frozen margin. So now your balance is $773. So in a way, I like to think of leverage as a sports car. So of course you can hurt yourself by driving a sports car. But if you know what you're doing, and if you're careful about it, and you're just driving it safely, then you can derive substantial benefits from it. And same thing with leverage. Of course, you can hurt yourself, and there are substantial risks associated with leverage. But on the other hand, if you know what you're doing, if you calculate your risks, and if you're careful about it, then you can derive substantial benefits from having that leverage. All right, so that's how leverage works. And that brings us to the end of today's tutorial. There we go, talked about equity and margin, and hopefully now you have a very clear understanding of how leverage works and why exactly brokers are willing to lend you that money. Okay, I look forward to seeing you on the next tutorial, and until then, happy trading. So, the take profit. Let's imagine that we have some sort of market movement, which is illustrated by this line chart on the left, and also let's assume that your analysis at this point in time suggests that we should enter into a buy order. And that's exactly what we do. Well, a take profit is an additional order which you can make part of your buy order. So basically you can make this alteration to your buy order, specifying that if the price ever reaches a certain level, then you want your buy order to automatically be closed. So you can always close any order manually with just by clicking on it and telling the trading terminal to close the order. But in this case, you are embedding a condition in your buy order, which is called a take profit. And this condition will check whether or not the price is at or above a certain level, which is marked here with the red line. And as soon as the price is at that level or above it, then the order will be automatically closed. So let's have a look at an example. Let's assume the market kept moving from where we entered, went up, then went a bit down, and then shot up straight through the take profit level. The green cross here marks where the order would have been closed, so you wouldn't have to do anything at all. It would happen automatically. And therefore you would earn a profit from this order closing, and that's why this is called a take profit. Now, for a sell order, we have a similar situation. Let's assume this is the market line chart, and then our analysis tells us to enter into a sell order, which we successfully do. Well, we can also embed a take profit in the sell order. As you would imagine, the take profit for a sell order has to be below the entry point, because we will earn profit if the market goes down where taking a short position in the market. So let's see what happens next. The market goes against us for a bit, then goes in our favor, then kind of flattens out a bit, and then it goes straight through the take profit. Stop loss. The concept of a stop loss is very similar to a take profit, but it is the other way around. It's opposite, actually. So this is our market movement. We enter into a buy order, and we can embed a stop loss with our buy order. So it's an additional order in the Forex market, but it is linked to our buy order. So basically what it means is if the price was ever to go and reach this red level or go below it, then the buy order has to be automatically closed. So that kind of saves you the trouble of monitoring the market and always worrying and checking if the price has gone down, because you put this rule into your buy order, and as soon as this condition is met, your buy order will be closed. So this is the market going down against us. So we were thinking it was going to go up, but actually went down, and then bam, price crosses our stop loss and the order gets closed. Of course, this yields a certain loss on our account. So at this stage, you would ask, why is a stop loss good, and if it brings losses? Well, let's see what happens to the market further down the track. It goes a bit up, it goes down, it goes up, and then it goes further down. So as you can see, there could have been potentially a much higher loss. Say this one, or even this one. So, or even more than that. And so it's better to control your losses and exit according to your trading strategy, and exit on time rather than overweight and bear a very high loss. So smaller losses are much better than bigger losses, and that's where your stop loss comes into play. It helps you exit the market, because what we're doing in trading is we won't always win in all of our trades. There will be losses. Inevitably, there'll be losses on the account. And it's all about managing those losses, managing those risks, and getting out of the market on time. And that's where your stop loss will help you control the losses on your account. It's a very important feature, and I highly recommend to always set a stop loss for any of your orders. Let's look at a stop loss for a sell order. So a sell order, we're anticipating a downward movement in the market. We can set a stop loss which has to be above the entry price, and that's because when we anticipate a downward movement, we will only lose if there's an upward movement. So let's see what happens in the market. The price goes a bit against us and goes kind of in our favor, but then it crosses our stop loss, and unfortunately there's a small loss on the account. Let's see what happened to the price going forward. Went up, went even further up. So if not for our stop loss, we could have closed the order there, or we could have even closed it there, and that would have been a much greater loss on the account. So as you can see, stop losses, even though they bring losses to the account, but they are very useful and very helpful in controlling your risks and managing any potential losses on the account. Types of orders on the Forex market. There are two main classes of orders on the Forex market, and these are market orders and pending orders. And there are two sub categories in the pending orders. These are stop orders and limit orders, and we'll have a look at all of them right now. So market orders. You're already familiar with these orders. These are the buy order and the sell order. Stop orders. So the first type of stop order that I'd like to introduce you to is the buy stop. So basically, the buy stop is a pending type of order. What that means is that when you set a buy stop, you're not actually entering the market. You're setting a condition or a trigger or a future order. So you're saying, if something were to happen, then I want my terminal to enter the market automatically for me. So basically what this, in this case, what's happening is you're saying that if the price reaches this green line, I want to enter the market with a buy order. So let's see how that happens. The price crosses the green line, and that's exactly when your buy stop order turns into a buy order. So from that red cross onwards, your buy stop order no longer exists. Now you have a buy order in the market. Sell stop order, very similar. So you're saying when the price crosses the green line, I want to enter the market with a sell order. See, when that happens, your sell stop order turns into a sell order instantly. So what's the benefit of these buy stop and sell stop orders? Well, it's basically kind of saving you the effort of actually waiting for the price to get to that level and then entering the market. So if you think that once the price crosses a certain price level or support line, you think the price will keep going downwards, that's when you would want to set a sell stop order and catch that movement as soon as it starts, rather than having to sit around and wait for it to happen. The other thing is that if that doesn't happen, if the price, for example, in this image that we have in front of us, if the price were to keep going upwards, then you would never enter the market at a sell with a sell order, because the price wouldn't have crossed this green line and wouldn't have triggered the sell order. So it's kind of a very convenient way to save your time and also check for specific conditions that you're looking for. Limit orders. Limit orders are similar to stop orders. A buy limit order is actually set below the market. So what you're anticipating is for the market to go down, touch your order, cross it, touch it, and then go back up. So you're kind of anticipating a recoil. You think that, yes, the market will go up, but first it will go down. And instead of entering right away, so you could have entered back here with a buy order, you want to get the most of this movement. So you want to actually let the market go down a bit, then enter with a buy order, and then you'll get this whole movement rather than getting only half of it. Once the red cross happens over here, your buy limit is no longer a buy limit order. It transforms automatically into a buy order, and you enter the market. That's the point when you enter the market, when the transaction occurs, the opening of the order. Sell limit, it's a very similar concept. You are anticipating an upward movement before a downward movement. So you think that the price will go up, it'll touch your sell limit order, trigger it, and then go down. Once again, you would do this if you're anticipating an overall downward trend, but you think there will first be some sort of retracement upwards. And instead of entering the market back over here with a sell order, you want to get the full movement, so you let the market go up first, touch your sell limit order, and then go down. So in this case, even if the market price crosses your sell limit order, it will still be triggered as a sell order. So there's always these risks that the market will trigger your sell limit order, turn it into a sell order, and then keep going upwards. That can also happen, and your sell limit order will be triggered and you will be in the market. And that's why you should still use stop loss and take profits with your limit and stop order. So even with a sell limit order, for example, you can tell it to set a stop loss and take profit. Of course, the stop loss would have to be above, take profit would have to be below, and it works exactly the same way, because remember, once the order is triggered, it will either turn into a buy order or a sell order, and all the same rules apply as before. So with your pending orders, you can also set stop loss and take profit levels, which will be triggered with the order, meaning that as soon as the order turns into a buy or sell order, the take profit and stop loss levels will be activated, and they will be protecting your order as they would with any other market order. So that sums it up for today. I look forward to seeing you in the next tutorial, and until then, happy trading.